Look, there is genuine uncertainty right now. War escalating, fake headlines moving markets 30 minutes apart. Nobody knows how this resolves. That uncertainty is the environment. And in that environment, if you are trading with leverage and no clear plan, no edge, no defined exit, that is not trading. That is gambling. Psychology matters more than any setup right now. Two types of people watching this. If you are a trader, know your setup, know your edge, know exactly where you are getting out. If you are a long-term stacker, your time frame is months, not minutes. Watching every 5-minute candle in this environment is not going to help you. The data is what matters. Drop OG in the comments if this is actually giving you clarity. I read them. Now let's get into it. Here's what actually happened in the last 24 hours. Iranian drones struck the U.S. consulate in Dubai and a CIA station in Saudi Arabia. The U.S. military now has 50,000 troops, 200 fighter jets, 2 aircraft carriers, and strategic bombers actively engaged against Iran. Oil hit $78, up 40% since December. Trump responded by ordering naval escorts through the Strait of Hormuz and directing the U.S. Development Finance Corporation to backstop all maritime trade in the Persian Gulf. Markets initially bought it. Oil dropped 4.5%, then completely recovered, every single dollar. Then a negotiation rumor surfaced and oil dropped again. Iranian officials denied it publicly within 30 minutes. Oil recovered again, and Rubio went on record saying attacks will increase in scope and intensity in the hours and days ahead. That is the world silver and gold is trading in right now. In the middle of all of that, silver dropped to $77, bounced to $86.80, and as I'm recording this, just before the 9:30 open, it is sitting at 84, already pulling back. If you have watched this channel for any length of time, you know exactly what happens around the New York Open. This is not news, it is a pattern. I am not going to call it anything other than what it looks like on the tape, and you can draw your own conclusions. Gold touched 5,000 even at the low, recovered sharply, and is now trading above 5,186. The DXY took out the January 15th high I flagged in the last video, surged above it, and closed back below it. That is a failed daily breakout, or what traders call a swing failure pattern. And that failure is part of why the floor held. I will get into what that means for metals specifically later in this video, so stay with it. Let's get into the data. COMEX silver open interest in the March contract has collapsed to around 1,500 to 1,800 contracts, roughly 7 to 9 million ounces. The CME shook out almost everyone from that contract, and if you were watching last week, you know there were reported technical difficulties during the process. The April contract added roughly 100 to 150 contracts, open interest rising to around 1,000 to 1,200, roughly 5 to 6 million ounces. What this tells you, the paper rollout is happening under stress. The people standing for March delivery are not rolling quietly. They are staying or being forced out, and the April buildup is something to watch as that delivery window approaches. Meanwhile, total COMEX silver inventory is now 355,173,000 ounces, a new one-year low. Registered silver sits at 87,985,000 ounces. Monday alone saw 2,391,000 ounces walk out the door across 3 separate vault custodians simultaneously, Brinks, CNT, and Loomis, all reporting outflows on the same day. The 30-day total drain is over 50 million ounces, a 12.5% reduction in 1 month. Now here is the leverage context that changes how you read those numbers. The total inventory leverage ratio sits at 1.62. The registered leverage ratio, the silver actually available for delivery against open contracts, is 6.55 to 1. That means for every ounce of registered silver that exists, there are 6.5 ounces of contractual claims sitting on top of it, and that registered number is still declining. When people say the physical market is fine, ask them to explain a 6.55 to 1 registered leverage ratio at a new one-year inventory low. Layered on top of that, 241 delivery notices were issued Monday alone. March total deliveries have climbed to 5,087 contracts, 25,435,000 ounces of physical silver being demanded through the delivery mechanism. JP Morgan stopped 71 of those contracts. Wells Fargo stopped 38. Bank of America stopped 37. These are not retail stackers buying coins. These are large institutions going through the formal COMEX delivery process to take physical metal off the exchange. And then there is the lease rate signal, still flashing. The 1-month silver lease rate should round to 0 in a normal market. It is not doing that. The 1-year swap rate is distorted in the wrong direction. Negative territory, pricing backwardation risk. Physical is more expensive to borrow because there is less of it accessible. And here is what makes that more interesting. Roughly 15 million ounces of physical silver were sold by retail investors since February 9th. That selling should have eased the pressure. It did not move the stress indicators at all. Separately, the SGE finally updated its silver inventory numbers today. Yesterday, I noted those lines were completely absent. What they showed when they came back: 13.2 tons drained from SGE vaults. The Shanghai Futures Exchange reported 407,000 ounces withdrawn on Wednesday alone. Total SHFE silver now sitting at 9,478,000 ounces. Total SGE silver at 14,308,000 ounces. Combined, that is 26 metric tons out of Shanghai in a single reporting window. One day, the Shanghai Premium answers the same question from the other side. Western Spot at 84 right now. Shanghai Spot at 97. $13 premium. That gap was intact, even after the 11% Western paper crash. Now the psychology, and I want to be direct because the environment demands it. There is enormous uncertainty right now. A war, the Secretary of State says, will escalate further. Fake headlines moving oil in opposite directions, 30 minutes apart. A DXY that tested a major level and failed. If you are trading this with leverage, you are not trading. You are gambling. One fabricated headline, and we saw several today, can destroy a leveraged position before you can react. Mark Douglas in Trading in the Zone made one central point. Traders fail not because their thesis is wrong, but because they cannot handle uncertainty. Right now, uncertainty is the entire market. You need to know exactly why you entered, exactly where you exit in both directions, and exactly what your time frame is. If you are positioned in physical silver for an all-time high before year-end and you are watching hourly candles, you do not trust your plan or you do not have one. The data you should be watching is what I just walked through. Inventory, lease rates, the premium, delivery notices, not a $2 paper move. This is not me telling you to buy or sell. Both sides of this picture are now on the table. What you do with it is entirely your decision, and that is the point. Now let's talk about what is actually happening in the Gulf, because this is where every other market gets its signal. Trump announcing naval escorts and DFC insurance for maritime trade is not a neutral stabilization play. It is a market management attempt, and the oil market rejected it immediately and completely. Price dropped 4.5% on the announcement and fully recovered within hours. The market is saying a naval escort does not eliminate structural supply risk. DFC insurance backstops trade finance. It does not move tankers through a contested strait or protect the upstream energy infrastructure those tankers depend on. The history here is not encouraging. A full U.S.-led coalition ran a sustained campaign against the Houthis in the Red Sea, a proxy faction in one of the poorest countries on Earth. Red Sea throughput still never recovered above half of pre-conflict levels. U.S. assets were lost. The campaign was ultimately judged a failure by U.S. military leadership. That was against a proxy. Iran has indigenous drone production running at an estimated 500 units per day, at $35,000 to $50,000 each, against U.S. intercept costs of $1 to $3 million per missile, often 2 or 3 needed per target. The asymmetry does not resolve by adding warships. The U.S. consulate in Dubai was struck by an Iranian drone. A CIA station in Saudi Arabia was struck. The Strait of Hormuz is under declared Iranian naval supervision. The U.S. military has confirmed sinking 17 Iranian naval ships, including a submarine. Iranian officials say they are not negotiating and are in this for the long fight. Rubio says attacks will increase in scope and intensity. And then the fake news question, because this is how markets are being moved right now. A negotiation rumor surfaces, oil drops. Iranian officials deny it publicly within 30 minutes. Oil recovers. Someone needs to explain who benefits from the down move in that 30-minute window. It is not retail. It is not physical holders. The pattern of algorithmic oil short triggering on a rumor that reverses immediately is not random. Apply the same skepticism to that you apply to everything else, and verify who had positions open when the rumor dropped. Oil went from 72 to 78 as conflict escalated. It dropped to 71 on the DFC and naval escort announcement, then recovered to 74 and is climbing. The rejection of that intervention move is the market's final verdict. This is a structural supply risk, not a logistical one. Zoom out. Rickards, in Currency Wars, called this financial warfare. The real battlefield is the architecture keeping the dollar dominant. $35,000 drones against $1 million intercepts aimed at the monarchies that recycle oil revenue back into U.S. treasuries. If that recycling slows, treasury demand weakens and yields rise. Capital is already moving. Euro, European equities, and bonds all falling together. That is a region being exited. It is finding the dollar for now. That is your short-term dollar bid. It is not a structural endorsement. Now the honest resistance case. Silver broke down technically on the previous leg. The 150 exponential moving average on the hourly failed. A bounce from 77 to 86.80 is meaningful. But notice where we are right now. 84, just before the 9:30 open, already giving back ground. That is not a recovery confirmation. That is something to watch. The DXY failed the January 15th breakout. If the dollar finds real follow-through and starts moving higher from here, I would expect renewed pressure on metals. That is not a signal, and it is not a call. It is tape reading. If DXY starts climbing again and makes a confirmed daily close above that January level, the path of least resistance for silver in the short term is more downside. Watch it. Do not trade around it blindly, but watch it. In a genuine liquidity squeeze, cash becomes king regardless of fundamentals, and forced liquidation hits everything. And the geopolitical outcome is genuinely unknown. Anyone claiming certainty about how this resolves is not doing analysis. They are selling something. Here is what to watch from here. The DXY, and I want to be specific about this, the scenario where the dollar starts moving higher again matters. If we get a confirmed daily close back above the January 15th level, I would be reading that as additional near-term pressure coming for metals. That is not a signal. That is not me telling you to do anything. It is tape reading, observing what the chart is telling you and thinking through the implications before the move happens rather than after. Watch the Shanghai Premium. If it narrows sharply, physical demand in China is easing. If it holds or widens, the paper price in the West is not where real buyers are transacting. And watch oil. If crude reclaims and holds 78, the conflict escalation framework enters a new phase. Energy is the leading indicator right now. Everything else follows it. Have a plan. Know your time frame. Know exactly why you are in and where you are out. And if you are using leverage in this environment, you are not trading, you are gambling. Invest with logic, not hype. OG out and about.